Securities, and we are here to discuss something which is new on the platter, which is a new fund offering by Invesco, which is a Invesco Business Cycle Fund. So before I go actually to the guest and talk about it, let me tell our viewers what is a business cycle fund. So business cycle funds are uniquely designed to take advantages of either sectors or companies or economies which are going through different phases of the business cycle. For a company, as you all would have known or heard, there's an introduction phase, which is a startup phase, and there is a growth phase, and there's a maturity phase, and then there's a decline. For economies, it's an expansion, then peak, then recession, and trough. So these things are a regular part of an economic cycle. And the reason why we are very bullish about, or why we are positive about this, is at times we all know that every sector does not perform every time. And to have a curated portfolio, a designed portfolio where probably there is a fund manager who identifies the best bets which are apt as per his research team, and then he places those bets. There's a high probability then the results are going in the direction what the investors are looking forward for. So this is about business cycle as a fund. Invesco, a lot of you would have already been invested in India. Invesco is an AMC, pretty old in India. Now they already hold almost like 1.3 lakh crores assets in India, but it's a very large name globally. If you see, they are listed on New York Stock Exchange, S&P, and globally they manage $1.8 trillion, which is approximately like 153 lakh crores. So it's a very strong expertise, very strong business acumen team which has come up, and that's where the collaboration is Invesco Business Cycle Fund, and it is already being approved by our internal research, which gives another stamping on the quality of fund which we are looking forward for. And to discuss more about this, we have Amit Ganatra, who is head of equities with Invesco Mutual Fund. Amit has an experience of more than 2 decades and is a veteran in the industry now. Amit, a very warm welcome to you, and let's quickly understand what this fund is all about.
Yeah, thanks, Abhishek, for kind introduction. Good evening to all the participants. What I'll do is I'll take you through some of the key highlights of business cycle fund in terms of how this product should be viewed, how we intend to manage the fund, and once I'm done, we'll keep then forum open for Q&A. Any questions that you might have on this fund or anything else that you want me to cover, I'll be happy to answer. So, as far as business cycle fund is concerned, many of you must be aware that this is not something that it's not a new product or something like that. Business cycle funds are there in the industry. There are almost 20 plus funds which are already there in the industry, and launching this fund at this stage has also given us an opportunity to understand in terms of how most of the business cycle funds are positioned. And that has also helped us to create our own unique positioning in terms of how we intend to manage this fund. And all that I can say is that once you go through my presentation, you will realize that this is a very differentiated. It's a very sharp kind of a positioning that we are creating here, and it is bound to create a very good and a strong portfolio for you in your investment, in your overall investments. So let me first start with business cycle fund. So typically in managing every business cycle fund that you have to understand, that you might have invested or you might have evaluated, one thing that we need to understand is that it is nothing but a combination of pro-cyclical businesses and counter-cyclical businesses. So every business cycle fund that you look in the industry, it will always be a combination of companies or sectors which are pro-cyclical today. Pro-cyclical means companies or sectors which are growing fast or doing well. And the other part is counter-cyclical. Counter-cyclical is companies or sectors which are not doing well right now, but are expected to do well in future. Now, as far as trying to create this combination, fund managers will use various tools to decide what is pro-cyclical and what is counter-cyclical. And what are the tools that the fund managers use? So generally in business cycle kind of a fund managers will do economic analysis, they'll do market analysis, they'll also do sector analysis. And what do I mean by that? So take for example economic analysis. So economic analysis में fund managers क्या करते हैं? So every economy, as Abhishek also mentioned, has to go through various phases because economies are very cyclical in nature. So sometimes economy is in an expansionary phase, sometimes it's in a slowdown phase, sometimes it's in a contractionary phase, and sometimes it's in a recovery phase. And depending on the phase that we are in, fund managers may decide that which sector one wants to be overweight or underweight on. For example, post-COVID, first few years post-COVID recovery, India was in an expansionary phase. And because India was in an expansionary phase, a fund manager would have taken a view that one needs to be overweight on financials, industrials, and consumer discretionary, which are domestic cyclical sectors. They tend to do well when economy does well. Now, in last 6 months, since the economy is in a slowdown phase, fund managers could have taken a view that if you do economic analysis, then you can form an opinion that you should be overweight on defensive sectors such as consumer staples, IT, pharma, etc. So this is one tool that one uses to decide which sectors are going to do well, and then one can position portfolios accordingly in a business cycle kind of a fund. The other tool that fund managers use is the market analysis. Now, market analysis is more concerned with how corporate earning cycle is behaving. So there are times when economy is doing very well. For example, 14 to 20 GDP growth was strong, but corporate listed corporate profitability was weak. And because listed corporate profitability was weak, uh, markets did not do very well. Now, in last 4 years, GDP growth has not accelerated much, but listed corporate profitability has been very, very strong, and as a result, markets have done very well. So once again, depending on the call that one has on economy, depending on call that one has on corporate profitability, fund managers can decide that these are sectors or companies which are pro-cyclical, these are sectors or companies which are counter-cyclical, and then they can form a combination and they can create a portfolio. Now, when it comes to sector analysis, uh, this slide is very, very important. Why? Because what this slide tells you is that if you look at in India, every year the top three sectors are very different as compared to top three sectors of previous years. So every time there are new winners, every time there are new losers. And honestly speaking, these winners and losers in terms of sectoral outcomes has nothing to do with both economic cycle and market cycle. There is zero correlation. And because it is difficult to identify beforehand that which sectors are likely to do well, generally what we have found is that most of the business cycle funds in India, they tend to adopt a counter cyclical approach. By counter cyclical approach, what I'm trying to say is that they all basically end up buying sectors which are not doing well today with the hope or expectation that at some stage these sectors will do well. Now, if that is what was to be done in our business cycle fund, then honestly we have been doing this for last 14-15 years in Invesco India Contra Fund. For all of you, those who are not aware, Invesco India Contra Fund is the largest fund that we have in among all the equity funds that we manage. And that fund exactly has been doing the same thing where we buy companies and sectors which are not doing well. And over a period of time, when they do well, we start booking profits, and then once again we buy something that is not doing well. So the point is that if we wanted to manage this fund with a counter cyclical kind of an approach, the way other funds are being managed, then we did not need another fund. For us, that is not the objective when we thought about business cycle. And that's why what we decided is that instead of focusing only on economic market and sector analysis, we will take two further extra steps and then decide what is pro-cyclical and counter-cyclical. And if we do this well, then we will be able to create a good curated portfolio for you, which will comprise of, pro-cyclical business and counter-cyclical businesses. And that portfolio will be very sharp as well as very, very differentiated. So what are the two extra steps that we are talking about? So the first step that we basically, are going to do is that post sector analysis will also do business cycle analysis. And what do we mean by business cycle analysis? So business cycle analysis, according to us, involves two things. Step number one, you divide each and every sector into various subsectors. Why? Because each subsector might be very differently positioned as compared to how that sector is positioned. For example, take financials. Now, financials, mein there are banks, there are NBFCs, there are asset managers, there are capital markets, there are insurance companies. Now, all these sub-segments are actually positioned very, very differently today. Take, for example, large banks. Large banks are actually growing slower than India's nominal GDP growth today, and hence they are counter-cyclical. NBFCs, many of them are having asset quality issues today, and hence they are counter-cyclical. However, asset managers, capital markets, they are pro-cyclical. Why? Because some of the companies in this space, if you look at all of them, they all are managing to grow faster than India's nominal GDP. On the other hand, insurance is once again counter-cyclical. Why? Because life insurance is being marred by some of the other regulations and hence not growing fast. And general insurance is growing slightly higher than life. Now take another sector, healthcare. Healthcare is divided into domestic pharma, pharma exporters, hospitals, CDMO, diagnostics. Now even here, domestic pharma companies are now, domestic IPM is actually now growing slower than India's nominal GDP, which means that these companies become counter-cyclical by nature. Whereas diagnostics is also basically comprising of companies which are growing slower than India's nominal GDP and hence counter-cyclical. However, if you look at hospitals and CDMO as a segment, then that is nothing but pro-cyclical. Why? Because companies in this space are today growing faster than India's nominal GDP. So effectively, by doing sub-sector analysis, we are able to more accurately position our portfolios in what is counter-cyclical today and what is pro-cyclical today. Take, for example, 3 years ago, if fund managers would have done just economic analysis and they would have decided that in an expansionary economic period, for example, in this cycle, if you would have bought financials, saying that that is pro-cyclical, the fund would not have done well. Why? Because financials entirely have not done well. However, if you would have done subsector analysis and taken a view that AMCs and capital markets are pro-cyclical, let me buy that, then the fund would have done very, very well. So the point is that it is very important that you do not stop at sectoral level, but take one step beyond and then divide each sector into subsectors and then decide what is pro-cyclical and counter-cyclical. The second step that gets involved in doing business cycle analysis is that, see, at any point of time, country undergoes certain changes. And as a fund management team, if you are able to identify some good, unique top-down themes, then these themes actually, end up influencing companies across different sectors. So take, for example, premiumization as a theme. Now, premiumization is one such theme which benefits not only the SUV segment of M&M, it also benefits five-star hotel business of Indian Hotels. It also benefits hospitals business of Max Health, and it also benefits, luxury watch retail sales of Ethos. Now, these are companies which all belong to different sectors, but they all are doing well right now. They all are growing faster than India's nominal GDP because they are benefiting from one common theme, which is premiumization. Take another theme, which is digitization. Now, digitization is what? Digitization is a theme where tech-savvy customers are able to engage with tech-savvy companies. And because tech-savvy companies today have been able to, get, I mean, they basically more and more customers are becoming tech-savvy. Automatically, these companies are managing to grow faster today. So here, if you look at, company like PB Fintech, now this company's top line growth this quarter was 48%. The entire insurance industry is actually counter-cyclical. It is not growing so fast. However, PB Fintech managed to grow fast. Why? Because it is benefiting from digitization as a theme. Similarly, if you look at quick commerce companies, they are growing much. They are actually selling FMCG products. And FMCG companies in India are not growing today, but these companies are growing very fast. Why? Because they are beneficiary of digitization as a theme. Similarly, we saw that hospitals was pro-cyclical. Why hospitals is pro-cyclical? Because health and wellness as a theme has caught up. And why this theme is today very strong? Because health insurance penetration in India is going up. As a result of that, more and more people want to get treated in good quality hospitals. Good, they want to basically get treated well. And the moment that happens, it is basically beneficial to large organized hospital chains. So the point is, in business cycle analysis, we will basically do subsector analysis and we'll also try and identify, some common themes, some unique themes, which basically can help us identify companies which can grow faster for a long period of time. And these are just examples of, some of these themes, that how companies in these themes have done well. And one can go through the presentation and understand that, these themes have been fairly beneficial for companies which are basically beneficiaries or which have participated in this theme. Lastly, we said that we'll not stop at business cycle analysis. We'll take one more step, which is company analysis. Now, irrespective of whether a company is pro-cyclical or counter-cyclical, one needs to understand that every company also has its own life cycle. So a company can either be in a startup phase, or it can be in a growth phase, or it can be in a mature phase, or it can be in a declining phase. Now in India, nominal GDP still grows at 10-11%. So you don't have companies which are in a declining phase. But lot of companies in India have now reached mature phase of their life cycle, which means that they don't grow faster than India's nominal GDP, even if they're pro-cyclical. And even if they grow for 1 year, next year, once again, their growth starts falling below India's nominal GDP. So the point is that in this fund, what we have decided is that irrespective of whether we buy a pro-cyclical business or a counter-cyclical business, we will always prefer companies which are in the growth phase of their life cycle. So what do I mean by that example? So let me give you an example. Now take utilities as a sector. Now utilities is a fairly mature sector. And because it's a fairly mature sector, you have companies like, Power Grid, NTPC, which are in a mature phase of their life cycle. But in the same sector, you have NTPC Green, which is actually in a startup phase. Similarly, two-wheelers. Two-wheelers also is a fairly penetrated sector. You have TVS Motors, which is an example of a company in mature phase. You have you have Hero MotoCorp, which is example of a company in mature phase. You have TVS Motor, which is example of a company in growth phase. And you also have startup like Ola and maybe, company like Ather, which will soon get listed. These are examples of companies which are in startup phase. So in one single sector, you can see that, companies can be in different phases of their life cycle. Now in this fund, what we are saying is that the portfolio will be a combination of pro-cyclical and counter-cyclical. So 70% of the companies will be pro-cyclical, 30% will be counter-cyclical. How do we define pro-cyclical? So pro-cyclical companies are companies where trailing 12 months revenue growth is more than India's nominal GDP growth. Counter-cyclical companies are companies where trailing 12 months revenue growth is lower than India's nominal GDP growth, but with the potential of recovery. In both these buckets, there is going to be a preference for companies which are in the growth phase of their life cycle, which means that we will avoid companies which are in the mature phase of their life cycle. So in that sense, this fund then becomes very differentiated as compared to most of the other funds. Uh, One is that the pro-cyclical, counter-cyclical component itself is different. As I already told you, that most of the business cycle funds are being managed in a more counter-cyclical manner. In our fund, it's the other way around. We have 70% pro-cyclical, 30% counter-cyclical. Why this kind of a mix between pro and counter cyclical? Because pro cyclical will basically give you high growth, but these companies are also not cheap. So to that extent, you cannot expect lot of PE rating. Counter cyclical basically gives you no, it is low growth today, but it can become high growth later on. And if you get your call right, then you get benefit not only of earning growth, but a meaningful benefit comes out of PE rating. So to that extent, this becomes a good combination. The other the other key differentiation in this kind of a strategy as compared to most of the other strategies is that, like, many times counter cyclical companies, managers end up identifying, mature companies. They are cheap, and because they are cheap, they look counter cyclical, but they end up investing in mature companies. What we are saying is that we will only invest or prefer growth companies, which means that mature companies in general will be avoided, which also means that we will be able to avoid lot of time growth traps and value traps. What are growth traps or value traps? So value traps are traps where company looks cheap, but the underlying growth is also very, very weak. And that weak growth is there for a long period of time, which means that that cheapness can never then, resolve itself. And growth trap are companies where, company looks to be in a very strong growth phase for 1 year, but after 1 year, the growth just falters. Why? Because the company was in a mature phase of its life cycle. So we don't want to fall into those traps. In order to avoid that, we have decided that we'll basically avoid companies which are in mature phase of their life cycle. So automatically, then this becomes a very sharp portfolio, very, very, I would say a well-positioned portfolio. We created a model portfolio. Model portfolio has almost, 30% plus kind of earnings growth. So it's a strategy which in right now in India, as we can see that, latest quarter Nifty earning growth was only 10 odd percent. So in a country where, earning growth is right now running at 10%, you will basically get exposure to the portfolio where earning growth is going to be very strong. Quality will be very high because pro-cyclical businesses are business which tend to do well. And it will also have a good blend of, pro-cyclical as well as counter-cyclical. Counter-cyclical will give you valuation comfort today, and it will also give you benefit of strong growth tomorrow. So I think that's how one should look at this fund. And once again, to repeat, it's a it's a good portfolio curated, with very sharp positioning and with a very decent differentiation as compared to most of the other funds in the industry. So with that, I will close. Any questions that anybody has on this fund, I'm happy to answer. Thank you.
Amit, it was very quick and crisp. I think what the investors will be looking forward to know, or what I personally liked, is a concentrated portfolio with companies which have 30% plus kind of an earning growth is something which every investor is looking forward for. But let me break the kinds of investors, and probably I'd like to have your response on that. So we have a category of investors who is new, and then there is a category of investors who is already invested into certain certain stocks. As you know, we are a broking outfit, and stock plus mutual funds. So, what will be your advice to them? Why this fund should appeal to them? If
No, because see, if you generally see most of the diversified funds today, so anybody who has invested into mutual funds, and that is
right,
true even for most of the funds which belong to our own house. That is, if
right,
somebody is exposed to our flexi cap fund or a contra fund today, suppose if I want to give a counter cyclical exposure to that investor,
right.
then you will find that almost all the business cycle funds, along with our diversified fund, they all are completely exposed to large private sector banks.
Mhm. Right,
Right. And that is our counter-cyclical exposure today. But in this kind of a fund, because we avoid mature companies, we have actually preferred NBFCs over banks, and we have zero
okay.
exposure to large private banks.
Mhm.
So the point is that see, this is the kind of portfolio that an investor will only get in either a AIF or in a very sharply positioned PMS kind of a setup. On a mutual fund setup, these kind of portfolios are generally not there.
Right.
Portfolios where you completely avoid mega caps. For example, our active risk versus our benchmark, which is NSE 500, is 91%. Generally, portfolios run with active risk of 55-56%. 91% is basically, at that other extreme. So the point is that this is a strategy which is very well curated. It's a very sharply defined and a sharply positioned strategy. And if you get it right
Mhm.
over a long period of time, what happens is that, see, if some of these companies, if their top line grows by 25-30% over a long period of time, then generally what market tends to do is that in the long run, that is over a period of 5 to 10 years, there is a very strong correlation of market cap growth versus top line growth. In short run, many times that correlation gets broken because valuations and other things also play an important role. But in the long run, if your top line growth is like more than 15-20%, then you tend to get that return also in your portfolios. And that's why while this is a thematic fund, so it's not a core product.
Right.
However however one such kind of product everybody should have. The other thing is that I also mentioned that we will be investing, we will be identifying some of these top down themes, and
Mhm.
we'll basically invest into companies which are beneficiary of these themes. Now, I'm sure that in last 1 or 2 years, all investors would have invested in either Make in India as a theme, or energy as a theme, or pharma as a, or CDMO as a theme, or premiumization
Yeah.
or digitization, right? Now, the way to look at this fund is that this is a fund. It is like a fund of themes. So instead of telling investors that,
Mhm.
okay, these are the sectors in which we will be overweight on, what we are saying is that the themes which make sense, we will be overweight on them, and the themes which don't make sense we will avoid. For example, we mentioned that clean energy is a theme here, but everything that is a theme does not necessarily mean that it will be part of the portfolio. We have avoided basically this theme in this portfolio. Why? Because in India, if you look at some of the solar companies, they are trading at expensive valuation and they are enjoying supernormal profits because of the tariff structure which is beneficial. At some stage, if US tariff goes up, then their profitability can fall, and then the P multiples might not sustain, because globally these businesses don't get very high multiples. So our point is that everything that is high growth does not necessarily mean that it will be part. We will basically exercise that caution, that judgment in terms of which themes are beneficial from a long-term perspective, which are the themes where profits look sustainable, and will decide to invest only in those themes. So in nutshell, this fund should be viewed as fund of themes. So I think these are the areas which make this product very different, very unique, and that's why every investor can consider this in their portfolio.
Right, right. I think the way you are describing it seems like a dark horse in everybody's portfolio, primarily. Amit, can you throw some light on how you define companies into various phases, as startup or a growth, and how long it's a growth and then mature? What are your internal parameters just to demarcate in a company, like what to choose and what not?
So any company whose top line, see, India's nominal GDP growth is 10%. Okay. Now, any company, if on a sustainable basis it cannot grow faster than that, then it's just an example of a mature business. And I
Right.
gave one example,
I
two-wheelers.
know you
Now,
talk about banks and large
take take
banks.
take IT sector for that matter. Now, IT sector also is a fairly mature sector. Now, in that sector, if you see the largest company, which is TCS, today at 29, I mean, at the top line that it enjoys today, it can now not grow faster than India's nominal GDP. Even
Mhm.
if it grows, it will maybe grow for 1 year, and then once again the growth will come back to single digit. And a
Mhm.
8-9% growth for TCS seems phenomenal. A 5-6% will look average. But the point is that that's an example of a mature company. Now, in the same sector, there are companies like, Coforge, Persistent, maybe Sonata. If they intend and if they get their execution right, then some of these companies can easily grow faster than India's nominal GDP, not for 1 or 2 years, but for 5 to 6 years in a row. And that is despite being the fact that they are also part of a sector which is fairly mature. So, point is that companies can be in different phases of their life cycle. For us, a company is a growth business. If it on a sustainable basis, it can grow faster than India's nominal GDP. It's in a startup phase. If it is growing very, very fast, but today, it's not fully established and profitability is not yet established, then you can say that it's in a startup phase. In a growth phase, it will grow faster than India's nominal GDP, but at the same point of time, it will be profitable. In mature phase, basically, it enters a phase where it starts growing slower than India's nominal GDP. And in a decline phase, your top line basically, needs to now start declining. वो फेज इंडियन कंपनीज में अब तक आया नहीं है बिकॉज इंडिया नॉमिनल जीडीपी स्टिल ग्रोइंग डबल डिजिट तो इंडिया
Right.
में ऐसी कंपनीज है नहीं.
Right. So, Amit, one more question. Since the construct primarily revolves around companies which are on aggressive on a growth phase, can you share us the split in terms of large cap, mid cap, small cap, or how the portfolio will be? Though I know it will be agnostic of market capitalization, but
Correct.
invariably this will be more on mid and small cap heavy.
No, okay. So weighted average market cap is 88 lakh, 88,000 crores,
Okay.
which basically I would say that it's a decent, weighted average market cap.
Right.
In terms of large, mid, and small, it is almost 33, something like that.
Okay.
Once again, it is not that we try to do something like this, but it is just an outcome. See, we have to understand one thing that, as per current SEBI definition, the large cap bucket or mid cap is now basically at 1 lakh crores.
Mhm.
So, and as a result, what is happening is that uh, companies which are like large companies in their own space, say for example, largest healthcare company in India, Apollo Hospitals, that is now a mid cap. Now, Mankind Pharma is the largest company in terms of volume prescription in India, that is also a mid cap. Largest asset manager in India, which is HDFC AMC, that is also a mid cap.
Right.
Now, the point is that lot of companies which are large companies in their own universe, or they are the leaders in their own sector, they are now defined as mid cap because our benchmark of mid cap has become too high. And to that extent, then, to say that, okay, whether, one has more mid cap or small cap exposure, does it really make the portfolio more volatile? The answer is no. Small caps, I can still understand below 25,000 crore market cap, but I would say that some of these mid caps in India are as good as large caps when it comes to business volatility. You cannot say that, Mankind or HDFC AMC will have more volatility than any other large cap because it's just that from SEBI definition or MFI definition perspective, these companies are mid caps today. But these are not mid caps by any means. I mean, these are large businesses. So, and that's why weighted average market cap should be given more relevance to. And weighted average market cap of this portfolio is fairly high. It's around 88,000 crores.
Right. This is really interesting. So we had few questions which we have already taken a while our discussion. So I'm not touching on few stock specific questions because obviously you will not looking forward to entertain all clients who have joined in this call. Please note this. This is a new fund offering. It is available till 20th of this month. In our digital properties, it is available till 2 o'clock. And I believe if you want to know more, you can get in touch with a relationship manager or you can write to us at a customer service. The fund is available and it is approved by HDFC Research, which adds more to our also understanding that yes, this will definitely be a value add to all the investors to participate out here. And Amit, one last question before we move on is how we will, since the portfolio will be of around, say, 35, 40 scripts, is there any upper cap in terms of per script participation or per sector participation so that we may avoid any anomalies or high fluctuation in a particular stock?
Yeah, so one thing that we have decided, so two things. See, one is that we have to understand that this is a 70% pro and 30% counter cyclical. And
Right.
being 70% pro makes it very high growth. Plus, there is 91% active risk, which means that
Right.
there is a reasonable risk taking in this portfolio. So then we also need to manage risk. So on
Mhm.
one hand, if you take risk, if you get it right, then you get reward. But then you also need to manage risk. And there are two risk-taking elements in the way or measures that we have decided to take in order to manage this portfolio on a long-term basis. One is that there will be quarterly rebalancing between pro and counter. So at the end of every quarter, basically, we'll see that how much is pro today, how much is counter, and we'll bring it back to 70-30. What it will do is that it will automatically help. So for example, if today it is 70-30, by the end of the year, a lot of counter cyclical companies do well, and we become 90-10, 90% become pro cyclical, 10% remains counter cyclical, then it will look like a momentum fund. We don't want to do that. On a sustainable basis, we want 70-30 mix, and that's why quarterly rebalancing will help in that regards. The second thing that we intend to do is that, see, generally fund managers, when it comes to identifying growth companies, they are very good at that and they do that well. But once the companies start doing well, then they just they just stop thinking about exiting. And as a result, what happens is that companies, they do well, they become large in your portfolio, and at the time when they are most vulnerable, that is, they have become more expensive, and now they are maybe now probably they will become counter cyclical. That is the time when the weightage is the highest. In order to avoid that kind of a risk, what we have decided is that at any point of time, at the time of buying, no company will be bought more than 4% of the portfolio, so that a single stock cannot decide the fortunes of this fund. Second thing is that even if the stock does well, if it crosses 5%, the weightage will be brought back to 5%. So as a
Okay.
result, any growth stock which does amazingly well, at any point of time, it cannot be more than 5% of the portfolio. So that way, that stock specific risk at least gets avoided.
Mhm. So anything which goes beyond 5% will be trimmed back to 5 or 4%.
5%. Correct, correct. It will be trimmed back to 5.
Okay, okay. Well, that makes it really interesting because we have a lot of investors who have been part of this rally till September, and then there has been a slow and steady, not slow and steady, but they are a very jerky one at some times in terms of market movement, and clients are really perplexed in terms of what they should do. So all these investors, please note this is a portfolio which is being created by a group of research analysts. Amit is not the only person who will be managing this, and so yes, there is a team which works around every fund, and then that's how they propose it to the fund manager. What all calls need to be taken, and the risk is being managed, it is mitigated across stocks and sectors, and only to those where they believe definitely there is a high scope of giving you a returns of 35%, 30% plus earnings growth potential are the stocks. Obviously, it's a new portfolio which is being created. And it's an apt time to create a right portfolio because a lot of opportunities have again opened up. Looking at the valuations, and the valuations have come down, not at every place, but yes, there are a lot of pockets now which which are looking at reasonable valuation, and that's where this fund will add value to create a portfolio for investors for long term. But I'd really say anybody is looking forward to participate should look in for long term, and that's what equity investing is for. Though it doesn't mean that the NAV will remain at 10. NAV will start at 10. It will have its own journey, but people should look in forward for 3 to 5 years, because that's where you can actually see the NAV multiplying from 10 to 15, 20 as the journey progresses. So thanks, Amit, for the call, and thanks all the clients for
Thank
joining.
you. Thanks, Abhishek. Thank you, everyone.
It's really
Thanks
pleasure.
for your
And,
participation.
thank you, everyone.
Thank you. Bye.